Money creation and circulation. The American monetary system relies on fractional reserve banking to create and circulate money, a process that drives economic activity and generates significant tax revenue to fund government operations. In this system, banks are permitted to lend beyond their reserves, typically holding 10% as required by the Federal Reserve, creating new money in the form of deposits. When an individual secures a $100,000 mortgage to purchase a house, the bank credits their account with a deposit, which constitutes new money, not drawn from existing cash reserves. The borrower spends this money by transferring it to the seller, such as a homeowner, who then deposits it into their own bank account. The seller's bank retains $10,000 as reserves and lends out the remaining $90,000, creating another deposit in a new borrower's account. This cycle of lending and depositing can multiply an initial $100,000 loan into $1 million, significantly expanding the money supply, which reached $21,560 billion in January 2025, according to the M2 measure, encompassing cash, checking accounts, and savings. This money creation process applies to both real property, such as land or houses within the $48,200 billion real estate sector, and consumable goods, like a $1 purchase of bubblegum using a credit card. Real property loans are secured by tangible assets, allowing banks to repossess the property if the borrower defaults, which provides a degree of financial stability. For example, a mortgage on a house valued at $300,000 is backed by the property's market value, which may appreciate over time, reinforcing the loan's security. In contrast, consumable loans, such as those for food or small retail purchases, are unsecured, relying solely on the borrower's promise to repay, which introduces higher risks of default and potential inflationary pressure if lending is excessive. The cumulative effect of lending across these categories is evident in the $20,400 billion household debt and $21,600 billion business debt recorded in 2024, reflecting the scale of money creation in the economy. Once created, money circulates through a multitude of transactions, fueling economic growth and generating substantial tax revenue, which amounted to $5 trillion in 2024. These transactions include wages paid to workers, payments to suppliers for goods and services, and consumer purchases ranging from groceries to vehicles. Banks amplify this circulation by re-lending deposited funds, creating additional deposits that further expand the money supply. The Federal Reserve manages this flow through monetary policy tools, including setting interest rates, which were between 4.75% and 5% in 2025, and conducting open market operations. By purchasing U.S. Treasury securities, the Fed credits bank reserve accounts, injecting new money into the economy to support the $45,560 billion federal debt. These purchases stabilize financial markets by maintaining bond prices, preventing banks from selling securities at a loss, and ensuring liquidity for lending and spending activities. The global circulation of the dollar, with $8 trillion held in foreign reserves, underscores its role as a cornerstone of international trade and finance. However, excessive money creation, particularly through unsecured loans for consumables, can lead to inflation, reducing the dollar's purchasing power, as observed during the price spikes of 2022 to 2023. The Federal Reserve's oversight is critical to balancing this risk, ensuring that money creation aligns with the economy's productive capacity, the maximum output of goods and services it can sustain. Historical parallels, such as the chaotic proliferation of local banknotes during the 1836 to 1913 period without a central bank, highlight the instability that can arise from unchecked money creation. The introduction of fractional reserve banking by the first bank in 1791 laid the groundwork for this system, but it was the Federal Reserve's establishment in 1913 that provided the centralized management necessary to prevent such instability, ensuring efficient money flow. The dynamism of money creation and circulation drives economic expansion, enabling businesses to invest, consumers to spend, and governments to collect taxes for public services. However, it requires careful regulation to avoid overlending, which can destabilize markets, as seen in the 2008 housing crisis driven by excessive mortgage lending. The interplay of lending, spending, and Federal Reserve oversight ensures that money circulates effectively, supporting a robust economy while addressing the inherent risks of fractional reserve banking. This process is intricately linked to the roles of the Federal Reserve and U.S. Treasury, which manage currency issuance, debt, and monetary policy to sustain this cycle of economic activity.